Hey fools, and welcome. I'm Jill Ralph here with Stuart Watson.
Hi, Jim.
Hi, Stuart. And we are here to talk about a very popular theme in investing, dividend stocks. A full 97 of the 100 FTSE 100 stocks pay a dividend, but not all is created equal when it comes to dividend stocks. So we're going to give you 3 warning signs when you're looking at dividend stocks. So I'm going to jump right in. And warning sign number 1. A company with an inconsistent track record of paying the dividend. So Stuart, it sounds pretty intuitive, but tell us, why is that a problem for a company or a dividend investor?
Yeah, I mean, most companies will try and increase their dividends steadily each year, so just maybe add sort of 5-6%, because generally that's what big investors like to see. They like to see a steadily increased dividend year on year. But there's not actually that many companies that can boast that sort of record. So we picked out a few. There's, for example, Tesco, ticker is TSCO. PZ Cussons, PZC, and Greggs, which is GRG. And these have all got great track records of over 20 years of paying increasing dividends. But there's very few companies in that position. So when you look back over a company's dividend history, you see cuts, or maybe it's passed its dividend altogether. You know, that can indicate it hasn't got a great track record over the long term. So that's a good sign to look out for if you want to avoid those dodgy dividend payers.
So warning sign 1, look for consistency in a dividend payment. Warning sign number 2, low dividend cover. Stuart, you're going to have to talk us through. What does that actually mean?
Yeah. So a low dividend cover is when basically the dividend is not that well covered by profits. So say a company earns 100 million in profits in 1 year and pays out 80 million in dividends. That's quite a low dividend cover. So a good example there at the moment is Man Group, particularly is EMG, and that's actually paying out more in dividends at the moment than it's actually earning in profits.
Warning sign number 2.
Yeah, that's a big warning sign. I mean, each year it says we'll pay this level of dividend, and it keeps on sort of prolonging the agony almost. But it can't go on forever.
So you're a little nervous about that one.
A little bit, yeah.
All right, so warning sign number 3, high yield. Dividend investors like to chase yield. It can work out, but sometimes it can be risky. So talk us through why is chasing a high yield dividend paying stock risky?
Yeah, I mean, we like high yields, but the danger is a too high yield. So a lot of people look at the average paid by the market, which is about sort of 3.5–4% at the moment, and they'll say anything sort of 50% more than that or higher, so say 6% or more, that's too high, and that's a bit of a danger sign. So a company that falls into that at the moment is Aviva, particularly is AV Dot, which I think is paying about sort of 7% at the moment. And quite often you get these high yields, not because the dividends have gone up, but the price has fallen. So you need to watch out there. So if it's too high, then that's a big warning sign normally.
So great. So there you have it. 3 warning signs. A couple companies that have Stuart a little nervous, including Man Group and Aviva. But then a couple companies that don't and that have a nice consistent track record of paying their dividend. Tesco, PZ Cussons, and Greggs. So that was our dividend warning special for today. Hope you enjoyed it. Thank you, Stuart.